Hello, this is Japanese Economic Review Channel. Today we present the April 2026 Japan Industrial Production Index. The Ministry of Economy, Trade and Industry assesses the current trend as seesawing. However, this superficial flatness masks an intense tug-of-war. We will unpack how surging technology demand is keeping the index afloat, while traditional automotive and chemical sectors drag it down. Let's look at the macro indicators. Production rose 0.8% month-over-month, marking the third consecutive increase. Shipments outpaced production, growing by 1.5%. This stronger demand led to a healthy destocking, with inventories falling 0.2% and the inventory ratio dropping 0.7%. While the overall trend is seesawing, the economy is digesting inventory through robust demand. The 0.8% production growth hides a sharp divergence. Tech and automation are accelerating, with general purpose and business machinery up 5.3% and electrical and IT equipment up 3.5%. Conversely, motor vehicles fell 2.4% and inorganic/organic chemicals dropped 1.8%. The tech, hardware, and capital goods sectors are single-handedly offsetting the slump in heavy mobility. Shipment data clearly illustrates the demand heat. General purpose and business machinery surged an incredible 14.2%. Electrical and information communication machinery also jumped 6.2%. Meanwhile, petroleum and coal products, iron and steel, and motor vehicles all suffered shipment declines. We are witnessing a stark contrast between a booming B2B tech sector and headwinds in consumer mobility. This divergence heavily impacts inventories. Fast-moving tech sectors are experiencing rapid destocking. Electronic parts and devices inventories plummeted 7.2%, and electrical and IT equipment fell 6.5%. In contrast, slowing demand is causing stockpiles to build, with general-purpose machinery and motor vehicles accumulating stock. Mapping this data creates a health diagnostic matrix. In the top left, electrical, IT, and electronic parts are in a high-demand, supply-constrained state. In the bottom right, motor vehicles and iron/steel face a glut, with falling shipments and rising inventories. This bifurcated landscape proves that relying solely on the aggregate 0.8% growth is an illusion. Diving deeper into tech, the semiconductor ecosystem is leading a robust recovery. Electrical and IT machinery production grew 3.5%. Electronic parts and devices also grew 1.6%. Driven by demand for IC measuring equipment, memory ICs, and LCD panels, these sectors are clearing inventory rapidly, signaling excellent supply chain health. Comparing mobility and machinery highlights another contrast. The motor vehicles sector is a major drag, with production down 2.4%. However, machinery sectors serve as a powerful engine, with general-purpose machinery growing 5.3%, driven by conveyors and cranes. While consumer mobility struggles, factory automation is booming. Foundational base materials are cooling off, acting as a structural anchor. The iron and steel index remains subdued, and its shipments dropped 3.6%. Petroleum and coal shipments took the hardest hit across all sectors, declining 4.4%. These legacy-heavy industries face prolonged adjustments and require close monitoring moving forward. Looking ahead, METI's forecast survey projects a sharp 5.1% rebound in May, driven by production machinery and transport equipment. This will likely be followed by a slight 0.4% correction in June. This highly volatile pattern confirms the seesaw nature of the current economic cycle, but May's surge offers strong optimism. In conclusion, the macro view of a flat economy is an illusion. Sectoral divergence is massive. The tech and capex boom is the undeniable engine of current growth, while legacy-heavy mobility remains a structural anchor. Decision-makers must navigate this K-shaped recovery by aggressively targeting tech while buffering against heavy industry slowdowns. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.